In this video, I'm going to show you a trading strategy that will dramatically increase your win rate and profits. If you trade options, you must have experienced this scenario where you buy a call, the stock goes up, but you still somehow end up losing money, especially during earnings. That happens due to something called theta decay and IV crush. With this strategy, you can completely eliminate that problem so that you can make more profits and save your losses. This is a direction stock replacement strategy. It is better than buying call or put options because it gives you exposure of 100 shares. If you buy an at the money call or put, it usually have 50 delta. That means it has exposure to 50 shares of the stock. But with this strategy, you get 100 delta, which gives you access to 100 shares of the stock. So that means you can make more profit with lower risk and less capital than buying stocks. It has unlimited upside but limited downside. It works on any ticker, including SPY, Triple Q, or any individual stocks. It can be used for short-term and long-term trades. You can use this for 0 DTE day trades. You can use this for weekly swing trades, or you can even use this for monthly or 1 year long trades. My name is Ravish and I've made multiple 7 figures in trading profits using strategies like these. If you like this video, don't forget to hit the like and subscribe button so I can share more strategies like this with you. This strategy is called Zebra, which stands for Zero Extrinsic Back Ratio. It is a stock replacement strategy that gives you leverage equivalent to almost 100 shares, but it requires a fraction of the capital and risk. You can use this strategy to make bullish and bearish trades. This is much better than buying call, put, or even leap options because when you buy options, you pay a lot of money for theta decay, but this strategy has zero extrinsic value and almost no theta decay. Let's start with the trade mechanics and then I'll go over how exactly it works and how to execute this strategy. We can either make a bullish or bearish trade. To make a bullish trade, we will start by buying 2 in the money calls at 70 to 75 delta and then sell 1 at the money call at 50 delta. Here is how the math works. So if we buy 2 in the money calls at 75 delta, their total delta is going to be 150 and then we sell 1 at the money call with 50 delta. So we subtract 50 delta from it and then we will be left with 100 net delta. That will give us exposure equivalent to exactly 100 shares. And we can do a similar setup for a bearish trade. To make a bearish trade, we'll start with buying 2 in the money puts at 70 to 75 delta. Then we can sell 1 at the money put at 50 delta. This works with any expiry date. You can even choose 0 DTE expiry, 1 week expiry, 1 month expiry, or even 1 year expiry. That completely depends on your trade horizon. Let's visualize this using option strat to understand how it works. If I were to make a bullish trade on a stock like Tesla, one way to do that is that I buy 2 at the money call options. This is how most people trade. So if you buy 2 at the money call options, it is going to give you 50 delta each. So for 2 options, I will get 100 delta combined, but I would be paying $73 in theta premium every single day, which is going to accelerate rapidly as this trade gets closer to the expiry. The cost of this trade is going to be about $48.30 for both calls combined, and the max profit is infinite. Max loss is $48.30. But there is one big problem with this trade. It only has 32% chance of making profit. That's because the break-even point of this trade is at 354, which is 9% above the current price. So for me to make any profit in this trade, the stock has to go well over 9%, which is an uphill climb. If the stock does not move at all, or even if it goes up by 5%, I am still going to lose a lot of money in this trade. But we can fix this easily using the Zebra strategy. To set up this trade, we will first buy 2 in the money call options at 75 delta, and that is going to cost us about $4,000 per option, so $8,000 combined. But then we are going to sell 1 at the money call option for about $2,100, which is going to bring the cost of this trade down to $6,096. This will give us unlimited upside, but our max loss is capped to the premium paid, which is about $6,000. Now, there are a couple of things which makes this trade so much better. The chance of profit in this trade is about 50%, which is so much higher than just buying call options. And the break-even price is $325, which is just 0.2% above the current price. So that means even if this trade goes up a little bit by let's say 2% or 4%, we can still make profit. But if we were buying calls, in that case, we could have lost money. Let's compare how this strategy performs compared to buying stock or buying call options. So if I were to make a trade like this, when Tesla was trading at 325, to buy 100 shares of stock, I would pay $32,578. And to buy 2 at the money calls, which is going to give me similar exposure, I would have to pay 4,830, which is a fraction of the capital. To make the zebra trade, my cost would be $6,096, which is also a fraction of buying stock. The probability of profit while buying stock is technically 50%, because there can be one of the three scenarios. The stock can go up, stays the same, or it can go down. So technically there is 50-50 chance of it going up. So in reality, the stock has higher than 50% chance of making profit. But if I'm buying at the money call, the probability of profit is only 33%, because the stock has to go well over 9% for me to make any profit. But if I make the zebra trade, the probability is exactly the same as buying stock, which is 50%. So in reality, it can be slightly higher than 50% as well. Now, there are going to be three scenarios if the market goes up, down, or sideways. So if the market is sideways and the stock stays the same, I'm not going to lose any money if I buy the stock. But if I buy the call option, I'm going to have a 100% loss if the stock stays the same by expiration. But if I make the zebra trade, I'm going to have similar probability as the stock. So I'm not going to lose any money because the break-even price is exactly as the price of my entry. Now, if the stock goes up by 5%, I will make 5% profit in the stock, but I'm still going to have a 50% loss in the call option. So you can see here in the profit and loss chart, if the stock is up 5% by expiry, I'm still going to lose more than 50%. That is how the call options work. But if I use the zebra strategy and the stock is up 5%, I can still make well over 30% profit in that scenario. So there will be a 50% loss if the stock goes up with a call option and 35% profit with the zebra strategy. Now, if the stock goes up by 10%, in that case, the stock is going to make 10% profit. The call option is going to make 20% profit, but the zebra strategy is going to make 62% profit, which is 6 times the profit compared to buying the stock and 3 times the profit compared to buying the call option. But if the stock goes down, I'm going to lose money in similar proportions. If the stock goes down by 5%, with the stock, I will have a 5% loss. With at the money call, I will lose 100%. And with zebra, I will have somewhere around 30% loss. Now let's see how to make this trade in Robinhood. To make this trade, I will go and search for the stock ticker, which is Tesla. And then I will click on Tesla trade options. And then I will select my expiry date. So if I want to select an expiry date, which is 35 days away, I'm going to select the date. Now I need to find a call option, which is at 75 delta. So it is going to be in the money below the current price. So I will scroll down here, and at 300 strike, it is 70 delta. At 295 strike, it is 73 delta. So I'm going to go with 295. So I'm going to click one here, and now I need to sell a at the money call, which is going to be 325 or 330 strike. To do that, I'm going to switch this toggle to sell, and then I can sell 330 call. Now on the right side here, this is what my trade looks like, but this is not correct. I need to change the ratio of my spread. To do that, I'm going to expand this and click on custom. And then for the buy 295 call, I'm going to change the quantity to 2. And for sell 330 call, it is going to be just 1. So now the total cost of this trade is going to be 61.13. So I can now just click on continue and then review and submit my order. And I can set up a custom price here. Just like any trading strategy, this strategy also has certain risks, and here are a few ways to manage it. So the biggest risk with this strategy is that if the stock is below the long call strike at the expiration date, then the trade will expire at 0. So if I'm making a trade on Tesla where I'm buying 295 in the money call, by expiration, if the price of Tesla is under 295, then this trade is going to go to 0. This happens with most of the option strategies. So there's nothing very different here. But the way to mitigate that is that you want to choose an expiry date with twice the duration of your trade outlook. So if your trade outlook is 1 week, you want to choose minimum 2 weeks expiry. If your trade outlook is 1 month, then you want to choose 2-month expiry. If your trade outlook is 6 months, then you want to choose 1 year expiry and then close the trade halfway through the duration. For example, on this Tesla trade, if I choose a date that is 1 month away, that means ideally I want to exit this trade halfway through the duration. So after 2 weeks, I will plan on exiting that trade. At that point, let's say if the stock is up by 5%, this trade is going to be up by something like 20 to 29%. And at that point, I can exit this trade. If the trade is in a loss, let's say if it goes down by 5% and it is down by 30 to 35%, at that point also I can exit this loss. If I'm still bullish on this trade, then I can make another trade with longer time duration. You can also use this strategy as a LEAPS alternative with 6 months, 1 year, or even 2-year expiry. That will give you a much longer runway where you will have much higher chances of winning. It is also a good idea to set a mental stop loss on trades like this, because with option spread trades, if you set up a mechanical stop loss, they can be executed prematurely at a very poor price where you can result into losses that weren't actually there. So it is always best to set up alerts for the exit price, and when the stock hits that exit price, then you exit the trade manually and only risk what you're willing to lose, because this kind of strategy can have large losses if the stock goes down a lot. So do not risk more than what you're willing to lose. Do not go all in on a trade like this. Only use a small fraction of your capital. This strategy works very well if you're correct on the direction of the market. But if you are incorrect, then it can have significant losses. But if you want an even better strategy that makes profit even if the market goes up, down, or in circles, it generates weekly passive income, makes higher profit, has a very high win rate, and it comes with rolling and adjustment options to turn losing trades into winners or break even, then you can sign up for it on my website. You can find link in the description below.